Hey YouTube, welcome to the CFA Create Fun Always series. And today we are diving into WACC, the weighted average cost of capital. We'll break it down with analogies, real CFA questions, and no boring lectures. So let's go. So WACC stands for weighted average cost of capital. Think of it as the average rate a company has to pay to get funding, whether through debt or equity. The formula looks intimidating, but it's really just a fancy blend. E is equity, D is debt, V is the total capital, RE is return on equity, RD is cost of debt, and TC is the corporate tax rate. So if you ever wondered how much does it cost a company to get money, this is your answer. Now let's talk about a relatable example. Imagine you are buying a house. You put 70% on a mortgage, low interest, great. But the last 30%, you slap it on a credit card. Not ideal. Now, your actual cost of the house isn't just your mortgage rate, it's the average of both. Same deal for companies. WACC is the average cost of funding from different sources. WACC is more than just a finance formula. It's your company's goal or no-go line. If a new project earns more than WACC, awesome, it adds value. But if it earns less, it's literally destroying shareholder value. It's used in DCF, IRR, NPV, all the big dogs of valuation. So yeah, WACC matters a lot. So question for you. Why do we adjust the cost of debt for taxes when calculating WACC? Take a second to think it through and pause if you need to. Because interest is tax deductible, so the real cost of debt is actually lower than it looks pre-tax. Next question. When is WACC the right discount rate to use for a project? This one is super common on the exam. The answer is when the project's risk is similar to the company's existing business. If it's a totally different risk level, like a software firm launching a mining venture, adjust the rate. Okay, now let's spice it up. What happens if a high-risk project uses regular WACC as its discount rate? What would happen is you might greenlight a bad idea. Using WACC underestimates risk in that case, so you end up accepting projects that actually destroy value. WACC is based on the average risk of the entire firm. It's appropriate only for projects that are similar in risk to the company's existing operations. But if a project is riskier than average, say a startup entering a new volatile market, using WACC doesn't reflect that higher risk. The discount rate is too low. The result might cause the project's NPV appear positive, even though it shouldn't be approved. Last question. How does taking on too much debt affect WACC? Think beyond just cheap debt. At first, it lowers WACC because of the tax shield, but pile on too much debt and investors freak out. Risk goes up, so the cost of equity rises. Eventually, WACC starts to climb too, so balance is key.